Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Today, we're going to take a close look at Capital One's $5.1 billion acquisition of Brex, breaking down what this means from an investor's perspective. This deal represents a significant move in the financial services sector, combining Capital One's established presence with Brex's innovative approach to business credit. Over the next slides, we'll explore the key details of the acquisition, the strategic reasons behind it, and how it could impact both companies and their shareholders going forward. The acquisition of Brex by Capital One, valued at $5.1 billion, didn't attract the usual widespread attention, especially coming after Capital One's much larger deal with Discover Financial Services and a lot of other news in the economy. However, this deal could be much more important for how business banking evolves. It's not just about credit cards. Brex represents something bigger. It's about controlling the core technology behind corporate finance, where payments, workflows, treasury management, compliance, and AI all come together. Capital One's move shows confidence that future profits in financial services will come less from simply having a big balance sheet and more from owning software platforms that are deeply integrated into how businesses manage their money and operations. This sets the stage for a new kind of banking focused on technology and efficiency. At first glance, the key question is why Capital One chose to acquire Brex at this particular moment and valuation. It's important to consider what strategic benefits Brex brings that Capital One couldn't achieve through internal development. Brex's innovative technology and customer base offer an edge that might be difficult to replicate quickly within the traditional banking framework. The crucial point for investors is whether this merger will create lasting value for shareholders. We'll examine the deal from the perspective of its strategic rationale, how it's planned to be executed, what factors will determine its success, and its early financial impact, before exploring what this means for Capital One's future capital allocation and position in the competitive landscape. This analysis aims to give a clear picture of the merger's significance beyond the headline numbers. Capital One's deal to acquire Brex in January 2026 was set at a valuation of about $5.15 billion, structured as an equal mix of cash and stock. The acquisition completed in early April after going through all the required regulatory steps. Brex, founded in 2017, is known for its fully integrated business finance platform, which includes corporate cards, software for managing expenses and spending, business banking services, and tools powered by AI to help with automation and compliance. This combination offers Capital One access to an innovative fintech player with technology and services that complement traditional banking solutions. The acquisition aims to enhance Capital One's offerings and position it strongly in the evolving financial services landscape. At its peak in 2022, Brex was valued at $12.3 billion. The acquisition by Capital One, however, reflects a significant valuation reset of nearly 60%. This change is partly due to the tighter funding environment in the fintech space, but also because Brex shifted its focus strategically from serving early-stage startups to targeting enterprise clients between 2024 and 2025. This shift in business strategy is important to understand as it directly impacts both the company's market positioning and the valuation applied in the recent deal. The combination of these factors provides context for why the acquisition price is significantly lower than Brex's previous valuation peak. Capital One's main source of earnings has traditionally come from consumer credit cards and lending spreads, but with increasing pressure on interchange margins and tougher regulations, the company is shifting focus towards fee-based, payments-driven revenue. Acquiring Brex gives Capital One immediate growth in corporate card issuance, higher B2B transaction volumes, and subscription-based software income. This supports Capital One's goal of reducing reliance on net interest margins and building more stable, recurring revenue through platform services. Brex's agentic AI architecture is a key reason for this acquisition. Their software agents automate processes like receipt capture, policy enforcement, expense auditing, and accounting reconciliation. Building these advanced systems internally within a regulated bank would normally take around 5 to 7 years, so acquiring Brex allows Capital One to leapfrog that timeline. This acquisition not only buys technical time, but also enhances Capital One's credibility in AI-driven financial software, positioning them well for the future of finance technology. Brex already serves over 30,000 businesses, including well-known technology-driven companies like DoorDash, Coinbase, OpenAI, and Zoom. These customers tend to have higher transaction volumes, show less sensitivity to price changes, and offer more opportunities for cross-selling products and services. By acquiring Brex, Capital One immediately gains access to these fast-growing small and medium-sized enterprises and large tech firms, areas where traditional banks have struggled to perform well. This acquisition helps Capital One strengthen its position in high-growth corporate segments and tap into the dynamic needs of these innovative businesses. With this acquisition combined with Capital One's control over the Discover network, the company now manages key parts of the business payments ecosystem, including issuer economics, network infrastructure, merchant acceptance, and the software that orchestrates these operations. Having control over these layers creates a vertically integrated business model, which is a significant advantage. It positions Capital One to directly compete with major players like American Express and JP Chase in the corporate payment space, where owning the entire platform rather than just offering credit is becoming increasingly important. This integration supports a more seamless and efficient payment experience for clients and enhances Capital One's ability to innovate and deliver value in high-growth corporate segments. Brex's revenue model is centered mainly around software economics rather than traditional banking. It primarily earns from subscription fees for its software as a service platform, captures interchange fees when customers use its cards, and offers value-added automation services that simplify financial management for businesses. Although Brex wasn't fully profitable at the time of acquisition, it was generating a gross revenue run rate close to $700 million. Importantly, the margins on its software products are significantly higher than those typically seen in traditional banking, which aligns well with Capital One's strategy to shift towards higher margin, technology-driven financial services. This approach supports the broader goal of owning a full-stack payment solution that integrates both the financial infrastructure and advanced software capabilities. Keeping Pedro Franceschi, the Brex founder, as CEO ensures that the company remains a distinct division within Capital One's commercial banking arm. This approach preserves the pace of innovation, which is vital for staying competitive in fintech. It also helps keep key engineering talent engaged and minimizes culture clashes between the two organizations. For investors, this strategy addresses a common risk seen in fintech acquisitions when products stagnate after the deal closes, by maintaining the founder-led vision and operational independence that drive continued growth and development. The integration process is expected to cost around $950 million over 3 years, covering both integration and retention efforts. The key to success is moving Brex's infrastructure over smoothly without losing clients. At the same time, we need to ensure there's no disruption during the integration with Discover systems. It's critical to keep service uptime high and maintain strict compliance with regulatory standards throughout this time. Institutional investors will be watching closely, so disciplined execution and careful management will be essential to meet these goals and drive long-term value. Brex's software creates strong switching costs because once customers integrate its expense management platform, it becomes central to their operations. This creates a valuable lock-in effect. Capital One's strength lies in its ability to cross-sell a range of financial products like lending, treasury services, foreign exchange, and payments to those same clients. Additionally, Capital One's banking licenses give the opportunity to grow Brex's presence internationally. The real test will be how effectively Capital One can increase revenue per client after the acquisition by leveraging these cross-selling opportunities and global expansion, building on the solid foundation Brex has already established. Integrating AI-driven automation into a regulated bank environment brings added focus on data privacy, model governance, and ensuring strong credit and compliance oversight. This increased scrutiny is essential to maintaining the trust of regulators and customers alike. Capital One's blend of being a technology-first bank with a proven track record of regulatory awareness positions it well to manage these challenges. Their experience navigating regulatory frameworks and risk management discipline provides a meaningful advantage, helping to ensure that innovation and compliance go hand in hand as the combined entity moves forward. Capital One's stock saw a slight drop when the acquisition was announced, mainly due to concerns about how smoothly the integration would go and some short-term impact on earnings. Despite this, management reassured investors that their existing share repurchase program remains intact, with over $14 billion still authorized through the end of 2025. On the balance sheet, about 80% of the purchase price is assigned to goodwill, around $500 million to capitalized software, and approximately $350 million to identifiable intangibles. This allocation shows that the deal is more about strategic growth than acquiring assets, which is an important consideration for investors thinking about the long-term value of this acquisition. This merger between Brex and Capital One goes beyond a simple acquisition. It represents a shift from Capital One's traditional role as a credit issuer to becoming a key platform owner in business payments, financial software, and AI-driven workflows. By investing $5.1 billion, Capital One is gaining a modern finance operating system, a tech-savvy customer base, and valuable years of AI development. The real measure of success won't show up in the short term, but over 5 to 10 years, as software revenue grows and margins improve. Capital One will increasingly compete as a provider of financial technology infrastructure rather than just a bank. If executed well, this deal might be remembered not as Capital One's largest acquisition, but as its smartest strategic move. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.